Welcome to this explainer. So, you're looking for the safe path to growth, right? Navigating your investments can feel daunting. As someone who truly values safety and steady growth, I know you just want absolute clarity. You've worked incredibly hard to build your wealth, and the very last thing we want to do is expose it to unnecessary danger. But, at the same time, pulling all your money out of the bank and stuffing it under the mattress, that just means losing your purchasing power to inflation over time. So, how do we solve this? Well, today, we're going to demystify this Nobel Prize-winning framework called modern portfolio theory. Now, I know it sounds super academic, but I promise you, by the end of our time today, you're going to see it as your ultimate, reassuring map to financial safety.
So, how do we actually grow your wealth without you losing sleep? It's the golden question, isn't it? Literally the exact dilemma every single conservative investor faces. I mean, you want to see those account balances go up, obviously, but you absolutely do not want to lie awake at night stressing about what the stock market is going to do tomorrow. We have to find a way to protect your hard-earned capital from all those severe market dangers while still, generating enough return to beat inflation and hit your long-term goals. And here is the good news. We don't have to guess. There's an actual mathematical approach to doing exactly this, and it all starts with understanding one fundamental trade-off.
Okay, let's dive into this. Let's look at the most basic rule of investing, the risk-return trade-off. Generally speaking, to get higher returns, you got to take on higher risk. The contrast here is pretty stark. On one side, you've got government bonds. These are considered very low risk, a true safe haven. And historically, at least in our model here, they offer an expected return of around 6%. Now on the other side, equities, stocks. They offer double the expected return, a whopping 12%. But they come with a really high level of volatility and risk. Now, as a conservative investor, your gut instinct might just be to hide entirely in bonds, right? But as you'll see, mixing things up actually gives you a safer, much more efficient path. To really understand why, let's compare a couple of hypothetical portfolios. Let's say portfolio A gives you a 6% expected return for a 5% risk level. Okay, but look right next to it at portfolio B. It gives you an 8% return for that exact same 5% risk. Given the choice, the decision is a total no-brainer. We would never, ever put your money in portfolio A because portfolio B gives you a higher return for the exact same amount of sleep lost. In the finance world, we'd say portfolio A is mathematically inefficient. It's just a bad deal. In my primary job, it's to weed out every single bad deal from your investments. Which brings us to the core of our whole strategy today. It's a concept developed by the brilliant economist Harry Markowitz, called the efficient frontier. Now, please don't let the technical name intimidate you. Think of this not as some heavy, complicated math problem, but as your ultimate financial safe harbor. Essentially, it's a curve representing the absolute best possible portfolios you can build. And when we say best, we mean the portfolios that squeeze out the absolute maximum expected return for whatever level of risk you're actually comfortable taking. Or, flip it around, the minimum possible risk for the return you need to hit. It is literally the definitive boundary of smart investing. Now, what's really interesting about plotting this map is how it visually separates the good from the bad. Imagine a graph. The horizontal axis, the x-axis, measures your risk, basically the bumpy ride of the market. And the vertical y-axis measures your expected return, the actual money you make. The efficient frontier is this beautiful, curved boundary pushing up and to the left. Why the upper left? Well, because up means higher returns, and left means lower risk. Any portfolio sitting exactly on that upper left boundary is totally optimal. It represents the very best combinations available in the entire market. It acts like this invisible safety barrier, constantly guiding us toward total efficiency. So what does this all mean for everything else? Well, any portfolio that falls completely below that efficient frontier curve is basically an inefficient trap. These are portfolios where you're taking on totally uncompensated market dangers. You're enduring all the bumps and drops, but you aren't getting the return you deserve for it. No way. I want to reassure you right now, our strategy strictly avoids anything below this boundary line. We are never going to settle for a dominated, inefficient portfolio when a mathematically superior one is sitting right there on the frontier. Okay, so how do we actually get your money onto that safe frontier? Well, the mathematical secret, the real magic mechanism of modern portfolio theory, is diversification. But wait, it's not just buying a bunch of random things. Step 1 requires us to find assets that behave completely differently from one another. Step 2 is where the magic happens. We combine assets that have what we call low or negative correlation. Basically, when one zigs, the other zags.
by strategically mixing these uncorrelated assets together, say, blending those incredibly safe government bonds with certain equities. Step 3 reveals the actual engine at work. We can reduce your overall portfolio risk without proportionally dropping your expected return. It's amazing. If you want some real-world proof of how incredibly powerful this is, look no further than the famous Yale endowment strategy. It was managed for years by the legendary investor David Swensen. See, Yale didn't just hold simple stocks and bonds, no. They heavily diversified across domestic and international equities, they added in private equity and real estate, and they even mixed in hedge funds and commodities. And why do they do all that? Because these are all very different asset classes with exceptionally low correlations to one another. The result was a portfolio that achieved incredibly strong long-term returns while perfectly managing the overall risk. It's efficient frontier thinking perfectly brought to life.
And this brilliantly illustrates what happens when you ignore this map. Let's look back at the dramatic stress test of the 2008 global financial crisis. Before the crash, so many investors were heavily concentrated in banking stocks, real estate, and all these leveraged financial products. They were chasing those high returns, sure, but they were carrying enormous hidden risk. So when the housing market collapsed, all those highly correlated financial assets crashed at the exact same time. The result? Absolutely catastrophic losses for anyone holding those deeply inefficient, concentrated portfolios. They took all the risk and had absolutely zero protection when the storm actually hit. But let's contrast that. Let's look at the investors who actually followed the efficient frontier map during that exact same crash. They held truly diversified portfolios that included defensive assets, things like treasury bonds, gold, international equities, and defensive market sectors. Because these assets behaved differently, remember our golden rule about low correlation? These investors experienced significantly smaller losses, much lower volatility, and a massively faster recovery when the dust finally settled. Their diversification actually improved their risk-adjusted returns exactly when they needed it the absolute most. Now, as your guide, I've got to be completely straight with you. While this blueprint is incredibly powerful, it does have real-world limitations. During severe, completely irrational market panics, like the initial outbreak of the COVID-19 pandemic, investors tend to panic sell everything all at once. And in those extreme moments, correlations can temporarily change, and honestly, a lot of assets might fall together. The mathematical benefits of diversification can briefly weaken. Markets just aren't always perfectly rational. So it's vital to know that even the absolute best map is going to experience the occasional, sudden, unpredictable storm. Let's move along and see how this builds the perfect solution for you. We know we want to be on that efficient frontier, right? But where exactly? Well, for a highly risk-averse, conservative client like yourself, we're going to look for the absolute leftmost point on that entire curve. We call this the minimum variance portfolio, or MVP. It represents the precise mix of assets mathematically proven to have the lowest possible risk out of every single combination available. It is your ultimate safe harbor. It's designed specifically for investors whose number one priority is protecting their capital and minimizing that bumpy ride. So what does this all mean? Optimal investing isn't about wildly guessing which stock is going to pop tomorrow. It's simply about balancing your risk and return intelligently. By avoiding those inefficient traps, harnessing the sheer magic of diversification, and using the efficient frontier as our guide, we can absolutely build a portfolio that protects your hard-earned wealth while still giving it the fuel it needs to grow. You have the knowledge now, and the map is laid out right in front of us. Are you ready to balance your risk intelligently and build your ultimate safe harbor? The math is clear, but the real question is, what exact mix of assets will plot your personal path on that frontier? Thank you so much for joining me in this explainer. Let's go find out.